is it a good time to buy stocks? Of course, a question that people have been asking themselves probably every day for the last 40 or 50 years, when it's become more accessible to buy stocks, and the everyday person has that access. Countless numbers of people every day of the trading year asking themselves, is now the time I should buy? Is it too expensive? It's been rallying so much the last couple of months or years. Am I buying the high? Or, oh, it's selling off so much. And that's the scenario that we find ourselves in currently. Is it falling so much that it's going to fall more? Is it a good time to buy in the good times or the bad times? An age-old question that contrarians and trend followers are constantly asking themselves. And I always like to pose a chart like this, looking at the S&P 500 for the last year, and the fact that in 2022, the S&P 500 fell 20%, and in the last week of action, we've actually had the worst week for the stock market of the very young, but 2 months old, 2023. So, 8 or so weeks to deal with. We just had our worst one. I usually like to use charts like this as a Rorschach test almost, which is like, if you see something that's down considerably, does that make you A, want to buy it, or B, want to sell it, or C, do nothing? But that's a less interesting, obviously, response. And that Rorschach test can kind of tell you if you're a contrarian or a trend follower. And while that's all well and good to take a personality test and figure out where you may be aligned, I wanted to put together some statistics looking at bad, or what we would call bearish, times in the stock market, and see if that's a good time to buy stocks, painting the picture of where we are right now. Of course, we've bounced off of those lows that we saw in October, November of last year, but still considerably lower from the highs that we saw in the later part of 2021 and the early part of 2022. And given the most recent sell-off of the last week, is a down market a good opportunity to buy? Because we hear all of these, you want to call them idioms or cliches or what have you, buy the dip, or when people get fearful, that's when you should be getting greedy, speaking to a down stock market being a better opportunity to buy. But then, of course, you always have your animal spirits telling you, I don't want to catch this falling knife, or, if it's falling, there's usually bad news surrounding the stock market. And then you can kind of trick yourself into thinking, oh, more bad news is going to come. But then the counteract to that is, well, that bad news is priced in, and the future bad news is maybe priced in here. So maybe I should buy now as the bad news is kind of peaking, and this cycle can go back and forth forever. So I said, to hell with the cycle and to hell with the cliches. Let's put some data behind it. First off, what are we looking at? Well, we're coming off the worst week here of the year, and we're coming off the worst year since 2008. S&P 500 down 20% last year. Like I said, not 2023, but 2022, you idiot. That being the worst year that we've seen since 2008, when the stock market was down almost double that amount. But still a significant downside that we saw last year. A lot of people will say, oh, it's still overvalued because we rallied 2 or 3 solid years in a row of double-digit upside performance for the S&P 500 going into 2022. So it's not enough of a sell-off to make me want to buy. I would be on the side of any significant sell-off might be an opportunity to at least look at buying stocks. And the numbers also back me up, that we'll look at here in a second. And we did bounce back in the early part of 2023, but now that we're off a little bit, inflation fears back, and we get maybe back close to those lows in the S&P 500, NASDAQ, and of course all the single stocks that make them up, is this down market a good opportunity, or does bearishness beget bearishness? Looking at the numbers, just the pure percentage likelihood of a bullish period of time, you can see that bearish periods do not beget bearish periods historically. In fact, the S&P 500 has increased 74% of years following a bearish year. So what's that tell you? If you have a year of negative price action in the stock market, historically, the odds of the next year being a positive year have been close to 3/4, almost 75% of the time the stock market has bounced back. And you can see that as you increase the duration of the period that you're looking at, the percentage likelihood of a bullish period gets higher and higher. So the theoretical there is 50-50, right? For anyone who's studied math or probabilistic modeling knows that the input for any market that you're randomly trying to survey is going to usually be 50-50 theoretical likelihood of it going up or down in any of those steps along its random path. The stock market, though, tends to edge higher about 53 or 54% of the time. Now, on a day following a down day, those odds, historically speaking, of success that next day are 56%. On a week following a down week, 59% historical likelihood of getting a bullish week there. And then on a monthly basis, 2/3 of the time, we saw a bullish month following a bearish month. And you can see here the trend culminating in years following bearish years. Almost 75% of the time were bullish, really getting those odds higher and higher. And that stuff makes sense, right? Because anyone will tell you in the long term, the stock market trends higher. And so if you have some downside in the stock market, whether it's a day, week, month, or year, in the long term, that'll tend to even out and the stock market will rebound and tend to edge higher. And so these odds making sense in the grand scheme of things, but the data absolutely supporting the fact that buying the dip is usually a good idea, especially if you have enough time to hold on your hands there. I wanted to look a little deeper at these numbers and look at the actual performance here. And you saw a similar trend in that first column of the S&P 500, whereby the more time you gave a given period that you're looking at, following a bearish period, you saw even greater upside action. And so on days following down days, the stock market averaged positive 0.1%, which doesn't seem like a lot, but in this world of theoretical 50-50 or theoretical average being 0% up or down, 0.1% is a pretty good edge on a daily basis, especially given that the stock market, while it can be volatile, probably averages standard deviation, average daily range is probably 0.5 percentage point to a full percentage point. So an edge of 1/10 of a percentage point in the upside direction is a considerable edge. On a weekly basis, almost 0.5% average higher following bearish weeks. On a monthly basis, now you're really starting to see this trend flesh out to a higher degree, which is following a bearish month, we saw the stock market perform positively by a full percentage point on average. And then you get to that year part of the table. And if we saw a down year in the last 20 years worth of S&P 500 performance, the following year averaged almost 10% upside. And going back to the go-to metric for the stock market at large is it averages about 5 or 6% higher over whatever time frame you're looking at. And so to put 3 or 4 percentage points on top of that here, if you're buying coming off of a bearish year, that's significant there, especially people who know other markets like interest rates or currencies that are more mean reverting, you look at the statistics for those markets, the fact that on the 10-year, if it had a down day, a down week, a down month, a down year, the average performance of the following period there was 0%. Like I couldn't make this stuff up here. I crunched 20 years worth of data and found no significant trend one way or the other for treasuries or the interest rate asset class at large. Same thing for foreign exchange on a day, week, month basis. The euro showed no significant trending one way or the other following a bearish period. So if the euro fell, in a given week, it fell maybe 1 or 2%, and you bought that thing thinking that, it's got to bounce back, like the stock market tends to bounce back, historically speaking, doesn't do that. What I thought was interesting, though, is if you give foreign exchange a long enough time horizon here, it does tend to bounce back a little bit. And that is, I think, owing to the mean reverting aspect of currencies. I mean, it's actually really beautiful. If you ever want to take a look, do your own fun case study, just find yourself either an ETF or futures or spot Forex market, like people like IG provide, and look at as much data as you can. Like go to the weekly or monthly time increment and look at 5, 10, 20 years if you can, and look at how beautiful, for instance, the euro against the dollar or the pound against the dollar or the dollar against the yen. These markets just oscillate around long-term averages. Really, really beautiful mean reversion, much akin to the stock volatility markets there, where you see the spikes higher in volatility and then it comes back down below its average and hangs out at its lows and then gets back up to its average. And it's really nice to see that. Very relevant in interest rates and foreign exchange if you ever want to do a case study there. But for the purposes of today's conversation, not witnessing this bounce back effect that we tend to see in the stock market. And again, just to hammer home here, 10% average move in a given year following a bearish year, that is really something. And I will, again, let you know that we are following a bearish year. The S&P 500 down 20% last year, NASDAQ down more than that, closer to 30% last year. And we have bounced back a little bit to start 2023, but still in the last, call it 14 months in red territory. So take that data for what you will. Of course, these are historical numbers. The future can hold whatever it wants to. You've got the dot-com bubble of the early aughts. That lasted more than a year. The financial crisis of 07, 08, that lasted a little bit more than 12 months, but tending to see a bounce back effect in these historical stock market crashes. So what's next? Options projecting for the rest of this year, S&P 500 between 3250 and 4750. And so what's that tell me? Well, if I'm looking to buy stocks and the market maybe in June or July or August gets up to 4750, that might be a good place to take some profits because that's where the market is kind of projected that it could get to by the end of this year. And so maybe it can get up there and then you take some profits, it comes back lower. But if that market, falls down close to, 3,500, 3,400, 3,300, that downside projection here, maybe an opportunity to buy down there. Of course, a lot of things always to do in the stock market, but interesting to see that historical data telling us the stock market does tend to bounce back after bearish time periods. And we are right now coming off the worst week of 2023. And of course, 2022 being the worst year in the stock market since 2008.